to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, thank you for that. As if that doesn't play every Saturday morning. Like the man said, this is the Bullington Capital Show. You can go to my website if you'd like to get a copy of this, or you can pick it up on iTunes, or you can go to 955thefish.com. They host this show as a podcast as well. So, having said that, now you've got 3 different places to pick it up if you miss it here. I'm not sure why anybody would do that, but that's okay. You feel free to call us 216-901-0945, 216-901-0945 if you have any questions. Got a lot of stuff going on this week. It's pretty interesting. Lot of stuff. Tesla's shutting down some of their solar factory capacity. They've laid off a lot of people because they've been having a difficult time fulfilling orders. Not that that's a big thing. I don't think it's a big thing at all. In fact, I think it's just growing pains when you're in a new industry and you're trying to shake it up and do a lot of different things. That just kind of happens occasionally. Hopefully in the long run, if it works like other businesses did, they'll get more right than they did wrong, and they'll survive and go on to see another day, hopefully. But, before I forget, I want to remind everybody, there's a workshop coming up relatively quickly. You can go to my website, bullingtoncapital.com, to learn a little bit more about it or sign up for it. There's no cost to attend. Seating is free. It is limited, though. And it's going to be held at the Tri-C Corporate College out on the east side. It's a very nice facility. It's going to be a Saturday morning. In the summers, I like to do all the seminars in the morning on Saturdays because it's hard to get people to come out on a weeknight when they've been cooped up all winter long and now the weather's better. So anyway, the seminar is on tax avoidance, not tax evasion. Those are 2 different things. But it's legal to try to avoid taxes. It's illegal to try to evade taxes. So we're not going to be talking about that at all. But there's some things that you can do to reduce the amount of taxes that you're going to pay. It's fairly significant, and it can be incredibly significant. In fact, I was just looking at one of my clients who's generating a little over $30,000 in income from his stock portfolios, dividends that are being paid. And I'm looking at this going, wow, at some point in time, he's coming up on 70 and a half here fairly shortly, not too long from now. And he's going to have to start taking money out of his IRA. So that's going to increase the amount of taxable income he's going to have. We're working on several different ideas for him. That's the type of thing that is completely doable. We've got different methods of trying to reduce the amount of income taxes you'll pay. I'm working with Russell Investments. Russell, the Russell 1000, the big indexing firm. Well, they also work as advisors to investment advisors, and they've got tax-managed portfolios. And I'm going to tell you, most of the tax-managed portfolios that you see advertised are just not very good, in my opinion. The vast majority of them are not very good, and they're not the same. And I guess that's one of the things that when you start looking around in my industry, certain things have similar names, and you can't just dismiss it because you might miss something that's pretty important. And more often than not, there are big differences in what people are saying, even though they may be using some of the same words. Tax avoidance, that comes up in tax managed. That comes up all the time in various investments. My point to this whole thing is that if you're going to try to manage your taxes and you're not going to kill the returns by doing that, what do I mean by killing the returns? Well, if you didn't want to sell, GE a couple of years ago because you were going to have to pay taxes on it, and you had a big position in GE, Probably really wish you'd have paid the taxes on that right now, because GE is down significantly from where it was. And by the way, it was the only original stock in the Dow Jones Industrial Index, the Dow Jones, the 30 stocks. That was the only original stock left in that index. General Electric was one of the original stocks back in the late 1800s that made it all this time, and now they're gone. Now they're no longer a part of that index. So they get around to making changes sooner or later. And all I'm saying is that there were an awful lot of people that worked at GE here in the greater Cleveland area, or for one of their subsidiaries, had a lot of GE stock and didn't want to sell it because they didn't want to pay taxes on the gains. And it ends up, I don't think I really have to say a lot about that. You can see how the stock is done. It's down a lot. Probably not coming back anytime soon. And in fact, the stock peaked in 1998. Think about that for a second. What year is it? That stock peaked in 1998. It's 2018 now. That's a long time to go to be down 70% or so. There were some dividends that were paid, and that's a lot of people were, spending the dividends, hoping that they wouldn't get cut. They've been cut. And anyway, make a long story short, see that's one of the problems when you start letting the tax tail wag the dog. There are solutions to that. There are lots of things you can do. And if you have highly appreciated stock, that's one of the reasons people don't like to sell that. There's this thing called a charitable remainder trust that you can set up. And I'm going to try to get one of my estate planning attorneys on to talk about those specifically, because I'm not an estate planning attorney, and I could get in trouble if I said something wrong. But the basic, I do know the basics very well. And you've got highly appreciated stock. You can oftentimes gift that money to a charitable remainder trust. Get a step up in cost basis. What does that mean? It means when you sell it to reinvest and diversify, you won't have to pay capital gains tax. It also means that you're going to get a credit for the amount of money, and the credit depends on how much you're going to leave to the charity. Well, that was one of their variables. As far as I know, again, I am not an estate planning attorney, and I've just revisited this topic just a little while ago, because this is one of the things that you can do. You can get a step up in the cost basis. You can get a tax benefit actually from selling your stock if you agree to leave some portion of it to a charity, and it doesn't have to be on your death. You can actually take care of your wife or your spouse. You can take care of your kids, make sure they have an income from those assets. That is really cool. I mean, so you're not leaving all that much to charity, probably slightly less than you would pay in taxes had you sold it. But see, those taxes don't come due until you and your family is gone or are gone. My language, my grammar stinks today. So anyway, that's something that we're going to talk a little bit about at the workshop. I think that's a really good idea. So you've got a tax managed portfolio from people at Russell. Russell is a huge asset manager. I mean, and they're in the trillions. And to do a really good job of being able to do that, you need to be one of those types of firms. You need to be a firm that's as big as they are. Well, why? Because if you're not, there are some of the techniques that they're going to use. Like, they can trade stocks between funds, and when there's a tax advantage to doing that, and because they have so many funds, their ability to do that is much greater than a firm that doesn't have several $1 trillion in assets. You see what I'm saying? The bigger you are, the more stocks you're going to be carrying, the more likely it is that you can do swaps between the funds themselves and that have a tax advantage. If you're just running one fund, or your firm is only a $200 or $300 million firm, you can't do that. You don't have the ability to do that. Even some of the firms that are like 3, 4, 5 billion are still not big enough to be able to do that. When you have a firm that consults and actually manages or co-manages hundreds of billions, that's a different story. You can do it. And it's one of the reasons I just started taking a look at this a few months ago, because for the longest time, nobody was doing it. Well, they were, but they weren't doing it like this. And by hanging on to stocks too long, many of those companies actually had suffered poor performance because they were hanging on to stocks, and the stocks ended up dropping, and they would have been better off just selling it and paying the tax. Okay. And so long story short, we're going to be taking a look at a couple different things. We're going to be looking at the tax advantage portfolios that are offered by Russell. I'll have some information there. You can take it home with you. We're going to be taking a look also at an investment-only annuity. Now, I know when I say the word annuity, a lot of people cringe. And I understand. A lot of annuity products are incredibly expensive on the inside. And all the prospectuses are written by Philadelphia lawyers, and the only lawyers I know are from Cleveland. Now, the prospectuses are unbelievably complicated, so finding out exactly what you're paying, very difficult to do. Incidentally, this is why the Department of Labor rule came into being for its brief lifetime. It's because insurance companies were bringing out products that were so complicated and so expensive, nobody understood what they were investing in, and they just aren't making much money in them. Well, that hurts the IRS, by the way, because when you make money and eventually start taking money out, you end up paying taxes. So the IRS got hurt. That's why the Department of Labor got involved. Anyway, make a long story short, looking at investment-only annuities, you're only in them for the investments, not the guaranteed death benefits, not the guaranteed income riders, none of that stuff. Okay, these are just for investments. What is the advantage to doing that? Well, there are actually several. First is that it's tax deferred. Everything that you put in there, no capital gains, no dividends, no distributions. As long as you don't take money out of it, it's tax deferred. You don't get a 1099. So you have more control over the taxes that you're going to pay. And I'm going to give you some examples at the workshop and show you exactly what I'm talking about. And this is a unique product. When I say unique, I mean it. This product that I'm talking about has the lowest mortality and expense charge. That's a charge that the insurance companies overlay on top of the mutual fund expenses for the work that they do. Okay, this one is $20 a month. You could have $1 million in there. It's still only $20 a month. That's unheard of to be that low. In addition to that, the mutual funds that are inside there, they're from all the major fund companies. You'll recognize all of them. Every major fund company that you ever heard of is probably in there because it's got over 300 funds in it. All the big boys, Vanguards, Fidelities, T. Rowe Price, you name it. American funds, they're all in there. And they're in there with their institutional shares. What's the difference between an institutional share and a retail share, one that you would buy if you went directly to the fund company? Well, the difference is in the expenses that they charge. Because the insurance company that administers this and set up the annuity product is buying institutional funds because they have millions of dollars going into it, they get the break. They get a break on the fees, and they pass that break along to you. If it sounds good, it's because it is. Lower fees, that's kind of nice. So anyway, we're going to touch on those things. We'll look at the what I was talking about a little bit earlier in the show. You're coming up on your required minimum distributions. This is where this can be very helpful. You start reducing the amount of taxable income that you have to pay taxes on outside of your IRAs before you have to start taking money out. When you're trying to accumulate funds, they accumulate a lot faster if you're not paying taxes on them. If you're paying a lot of taxes every year on your investments or adding it to your income, that's money that you could be putting towards your retirement that you're paying to Uncle Sam. So again, the Tax Avoidance Workshop, it's coming up Saturday, July 14th. It's going to start at 8:30 8:30 a.m. This is at the Corporate College, Tri-Cities Corporate College East, right off of 271 Richmond Road over there. You can go to my website, sign up online. It's free. There's no cost to attend. I think I still have, yes, I do. I know I do. I have another Chromebook to give away. So I'm going to give away a Chromebook at that workshop. And a Chromebook, for those of you that don't know, is actually a laptop that's built just to surf on the internet. I mean, actually, you can do anything you want because Google's got all their software that you can use offline on it as well. And their software, they have spreadsheet software, word processing software. In fact, my daughter's a preschool special ed teacher, and their school system uses all Google apps now. So kind of interesting. So you can check your email, surf the internet, write letters if you want to. While you're not on the internet, when you can't get internet access, you can do almost. It's almost a fully it is a fully functioning laptop. It just doesn't have the ability to run programs that aren't made for the Chrome operating system. And by the way, most of them will work on them now. So I guess I should say it's a Chromebook, but it's a really cool small laptop, and we're going to give that away at that seminar. Why? Because HP called me and said, "Hey, we're liquidating these things. Do you want some?" And I go, "Well, sure. How many do you have?" I think I got about 6 of them because they were. I got 6 of these things for under $1,000. 6 laptops for under $1,000. Can you imagine that? That is hilarious. But so I thought it would be a great thing to do, and pop those out over the. I think this is the last one I have. Yeah, I gave the rest of them away. So hopefully, well, maybe they'll keep calling me whenever they get closeouts like that, and I'm sure they probably will. If I bought 6 from that one, that's not like that's a huge number or anything. But anyway. You can call us here today if you would like to ask a question, 216-901-0945. Another thing I was going to talk about at the workshop. We've tried to do a couple of retirement planning seminars. I'm going to get, and the software, when I got there, wouldn't work. I'm getting there early this time. We're going to set it up and make sure that it's working for this workshop, because you're really going to want to see that tool that I'm going to talk about right after these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned.
Taking all the colors before they fade to gray.
And we're back. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. You can also reach me by going to my website, my email is at bill@bullingtoncapital.com, or just go to the website. There's a contact us form if you would like to reach out to us. I'm going to go to the phones right now. You can call us 216-901-0945 if you have a question, and I'm going to go right to Chris. Chris, how you doing?
Good. Hey, I don't know, a year or two ago, you were talking about a company called Box.
Yep.
And I was just curious, which has done very well.
Yep.
And although the earnings didn't seem all that exciting, didn't really matter, though, I guess. But then there's this Dropbox, which went up 40%, and now it's backing off again.
Yep.
I mean, are these companies the same? And I mean, they're all doing the same thing. And
yes,
I don't know.
are.
I mean, what? And so what? I mean, do you have an opinion on these things? Which one's better, or are they just too overpriced right now?
Well, see, I have an opinion specifically for you. Okay. And this is what I would do if I were you. I would use math over emotion, math over logic. Okay. I would come up with a set of rules that says, okay, this is the type of stock I'm going to buy when it has all this criteria, when it meets this criteria. And hopefully you will have, gone back, done some research and tested this so that you're getting good stuff. Like when you talk about Dropbox. Okay, so I'll pull up Dropbox. Revenue was $529 million in the last 12 months. it was up
Right.
20%. And by the way, Dropbox is box. That's the stock symbol. So the revenue was up 20%. Okay. They haven't made a profit yet. They're a very new company. They're spending a lot of money on a lot of stuff, marketing in particular, but the trying to get to a certain level of revenue. And they've got a ton of people that are working there. So basically, they lost $151 million on $529 million over the past 12 months.
Right.
So, and the reason I talk about it, it came up on a momentum scan. That is not an investment.
Right.
That's
yeah.
that does not meet the investment criteria that I have for my investment stocks. So when I'm talking about it, it's going to meet a very specific set of rules, set of mathematical rules. And I got stopped out of Dropbox. I'll never buy a stock at its bottom and sell it at the top because nobody does that. And nobody does that. People will say they do that because they've gone up and looked up the chart prices and see. but realistically, that's not done. So if a company comes up, and I run several models, if they come up, yeah, I'll do that. I'll buy it because it's based on math. Not my logic or not my emotions. And people love to they love to try to figure out the future of these companies. And you have touched on something there, which is very good. It shows good thinking. You know that they're not the only person that does this. There's Carbonite. Right. There's Amazon now. There are a ton of companies who aren't publicly traded, who sell the same sort. Yeah. So it's a highly competitive business. It's a relatively low profit margin business. The cost for them is more advertising and overhead because they don't actually buy anything other than the computers. They got to buy the computers, but it's not like Ford that has to buy 5,000 parts to build a car.
Yeah.
So some people like it because of that. I got to tell you that whole space, if it comes up on a trading screen, I don't even think I would do that anymore. It's just it's gotten so hard to make a decent return that way that I think you'd be better off doing something else. So like if you used look at the earnings before interest and taxes, that's very similar to operating income. So can you pay your basic business expenses? And then you can divide that by the enterprise value. That's the whole cost of buying the business, the stock plus the debt. Because when you buy the business, you got to pay the debt off too. And why would I look at that? And people will ask me all the time, well, why would I look at that? I'm only buying one share. Because somebody else, like a big company, that's exactly what matters to them. And if you want to find companies that are attractive with potential big buyers, you should probably be looking for those things that those guys are looking for. Not what you like, it's what you think they will like. And they will like a company that's generating a lot of cash for every dollar that they're going to end up paying for that business. And that's what that formula, it'll give you a yield. It'll convert the company into a yield now so that you can compare one against another one. And you can go out and buy. And by the way, I just described a big part of the BCAP value strategy. I do that with the top 1,500 stocks by size. I take the biggest 1,500 companies in the United States and I rank them all. And I take the top 30, those with the highest operating income yields, the highest yielding 30 stocks out of there. And every 6 months, I'll rerun that screen. And if they make it in there, they're in. If they don't make the cut the next time, they're out. So it's math over emotion, math over logic. And you'd have an incredibly difficult time keeping up with that model. I know because I do. I have a really tough time keeping up. Yeah.
Well, I think they're overpriced myself. I mean, I don't own them. And you sit here and you watch these stocks go up, and it's like, what is wrong with people?
Well, actually, it's a bunch of different stuff, too, because you've got these funds now that are buying based on market cap. That's my big argument against market cap weighting. It doesn't matter. That market cap only looks at how much the stock is selling for. That's it. That's all they're looking at. And that is the number one element of 95% of all the exchange traded funds on the market. That's unbelievable that they would take that. But, and they point to the fact that, well, it's worked well in the past. Well, that's true. It has. If you've got 20 years to wait and you don't mind being negative for 10 of them, then by all means, use that strategy. Because this is what happens. A company like Box that now has a $3.7 billion market cap on only $529 million in revenue that lost $150 million. Who would pay close to $4 billion so that they could lose $150 million? I'll tell you who, everybody that bought that stock.
Yeah, there you go. Hey, I want to ask you about something else. I've never heard you, and this is another investment I never had, is gold. I mean, you look at some of these countries now that are collapsed, like Venezuela, and had during the good times these people put their money in gold, they'd be the richest people in Venezuela right now.
Oh, and, actually, gold has not done well at all. You'd been better in a 1%
you don't think so?
savings account. No. When I was 16 years old, gold was $800 an ounce.
Yeah, I know.
I'm 55.
Yeah, but...
Dude, that was 40 years ago.
Well, I don't... Other than one gold coin my grandfather gave me, I don't own any. But, well, I'm playing with some numbers. I mean, you look at...
You better get all the numbers.
Well, you look at even a country like Canada, which is relatively stable, I would say. In 2008, it hit parity with, or just about hit parity with the U.S. dollar. If those people would have put their money in gold at that time, they'd be up 80%.
Yeah, you know what? If you bought Apple,
rather than down.
If you bought Apple in the year 2000, when it was selling for half of the cash they had on hand, after you subtracted out all their debt, you'd be really rich.
Yeah.
But you can't know that stuff. That stuff you're trying to know the unknowable. You know that stuff's unknowable. And by the way, that's a good point that you bring that up, because a lot of people don't know that. They don't know that what you just said, there's no way that you could possibly figure that out. That's like figuring out how many points the Browns are going to score in the third quarter in their fifth game next year.
0. I can figure that out. 0.
Yeah. Actually, your guess is probably that's pretty good, accurate. Pretty accurate guess, maybe. But you just don't know.
You just look at all this debt around the world, even the United States, which is now going to hit like 21 trillion.
Yeah, but it was higher after World War II than it is now.
Yeah,
if you adjust it for inflation.
I know. Well, I know.
25% higher. So
yeah, but I just don't. I don't understand how we even sell debt anymore.
Actually, it's because
is it just all magic?
Yeah, no, I'm glad you brought this up. This is why I keep telling people, the system works very well, and let me explain how it works. When they print more money to pay for the debt, and that's not exactly, it's an oversimplification, but they're going to continue to print money. They'll extend more debt, and if they try to balance that off a little bit over time, what happens is you get an inflation rate. If they print money too quickly to pay off debt, the way they did in the 1960s, because they started this program called Medicare that they didn't have any funding for, so they started. Yeah, it's pretty well funded. It's a big chunk of the federal budget. But the bottom line is, inflation is the result, and if you do it haphazardly or not carefully, and it's a constant balancing act, by the way. And there's no way to know exactly what to do. That's why you have to make adjustments. And fortunately, we've got a lot of really smart people that don't get enough credit in this country. There are some unbelievable geniuses behind the scenes, and if they weren't there, and they haven't been there, if they hadn't been there all along, we would have failed decades ago. Decades ago, we would have failed. But we do go through these periods where you get this higher than normal inflation. And that's what happens when you continue to build up debt and don't start handling your fiscal responsibilities relatively reasonably. And we've done a great job. This country's done a phenomenal job. And now it's actually being spread around the world. Other companies are doing it as well. And the natural effect of this is not that you're going to have a stock market that goes down and crashes. That's not going to happen ever. They will always come back. You know why? Because they'll print the money and they'll make the credit available. They'll do the same thing they've done since the Depression when they really learned how to do that. So you don't ever have to worry about the stock market crashing and never coming back again. That's not going to happen. At least not until somebody forgets that they have printing presses. When they forget that they own the printing presses that can print the money, then we're in trouble. You never know if that's going to happen. But the real risk is that your assets don't grow enough to keep up with inflation and to provide an income for you in your retirement years. That's the real risk. That's the what is it? What's that old phrase about the elephant in the room? I feel like George Bush now. I can't remember anything. But anyway, that's the real risk that you're facing. It's inflation. It's inflation that gets out of control. But anyway,
okay, all right. That's all I was curious about.
Hey,
thanks.
Well, thanks for calling. Yep. Yeah, that's what. That's really. I mean, that's it. Inflation. If prices double, say in 20 years, that's tough. That's tough to keep up with. Because you're going to have a 5% pre-tax return to be able to keep up with that on an after-tax basis. And right now, CDs aren't paying 5%, so you're going to have to take risk for that. And that's why we're doing this tax seminar. It's a big deal. It's been bigger now than it is ever. Even when the tax rates were significantly higher, it's a bigger deal today than it was then. Because when you take an after-tax, after-inflation return that you can get in CDs, your return is negative. Your money is worth less a year from now, even after you earned interest on it, because you had to pay tax on that, and prices went up more than your money grew by. You're becoming poorer as time goes on. That's the risk, one of the risks, the biggest risks that you face, especially when you're getting close to retirement, especially when you're trying to figure out how much money I need for retirement. Again, I'm going to talk about that at the workshop. I got that software down now. It's been improved. I got every adapter you can possibly get for a Mac. I literally have about 5 of them. And so that I know it's going to go, and I'm going a week early to make sure that I can pull this up, and we're going to have access to it at the seminar. I'm really getting, I've had it. I've had it with the technology not working. So I'm going a week ahead of time to make sure that the technology is going to work. And it's really nice. So a firm called BlackRock, you might know them. You might not. That's okay. $6 trillion in assets. These guys are huge. I mean, they're the largest asset manager on the planet. They use the Watson computer with the artificial intelligence to put together portfolios and give us ideas. They work closely with advisors like myself. They've got this planning tool I really like. I really like it a lot. So if you were to come in to the office, and you have to come in, by the way, you could do it over the phone or over the internet if you're actually tech savvy. Most people aren't. I don't really want the liability of connecting to someone's home computer from my computer over the internet. So I would say, yeah, just come in. I'll meet you somewhere. And we can crank out a retirement plan in 5 minutes. So if you're planning for retirement in the future, there's one aspect. If you're already retired and want to see what the probabilities are of you running out of money, that's the other aspect. And either one of those scenarios, we can plug the numbers in and in just a few minutes tell you what your chances are of being successful. How cool is that? Anyway, I hear the music. I got to take another quick commercial break. This is Bill Bullington right here on 1420 The Answer. Stay tuned because I'll be right back.
So caught up in the chase of fleeting fame, neon lights as they glow with a plastic flame, mesmerized, blinded by temporary games, everything.
And we're back. Hey, just want to remind everybody, got a workshop coming up. You can go online to my website, bullingtoncapital.com, to sign up for it there. There's no cost to attend. Seating is limited. They're going to put out it'll be a continental breakfast. Tri-Cities Corporate College, if you haven't been there, it's a very nice facility. Large, spacious seating area. We're going to talk about tax avoidance, what you can do. There's some new things out there you can do. And if you listen to The Fish, I think we're talking about, I ran a commercial on there, and we're talking about George Bush saying there's a new tax sheriff in town. Boy, I miss that guy. I just miss his, everything he said that was funny. And he had a lot of funny stuff. I mean, it was really funny. I like the one time, I forget where it was. He was talking, but he goes, well, fool me once, shame on you. Fool me twice, shame. Fool me can't fool me again. And he just couldn't remember that last line. So anyway, comic relief. And I should tell you that, I don't know, I am neutral when it comes to politics. 40% of the country supposedly is, I can't verify that because I didn't go around and take a poll, but roughly 40% are registered Democrats, roughly 40% are registered Republicans, and then you have what I call the decider party. It's not an official party, but I think it should be because it's the 20% that decides which elections, where the election's going to go. They vote from whoever they like the most, not by political party. So, and that's the party that I'm in. I'm in the decider party. And it's interesting. What's really interesting is how well the economy is doing. And I got to tell you, presidents really don't have a lot to do with that. They can set a tone, and a large part of the economy is really just confidence. So if you have confidence, or if business owners have confidence, the big business owners, I'm talking like the Fortune 500, not the owners, but the CEOs. If they have confidence, they'll spend money and try to grow their businesses instead of trying to cut back on expenses and lay people off. That has a big impact on the economy. So it's very interesting to watch what's been happening. It's actually been very good. There are a lot of industries that are doing very well. And by the way, these industries are not political, so they'll do well no matter who's in office. And those are the big drivers. Those are the big drivers of the economy right now. Most of them are technology related. And see, the thing is not the technologies. You don't really want to invest in those technologies that are driving the economy, because just like the caller in, Dropbox is one of the big drivers. They've had 20% growth when you're doing $500 million in, was it 500 million or 500? Yeah, it was 500 million. So they're doing 529 million, and they grew by 20%. That's a huge growth rate in sales, but they're not that profitable. They're not making a lot of money yet. So the share price has gone up a lot, but it'll come down a lot at some point in time. But what happens is that all the people that are working there, the ones that are working for that company whose revenues just hit $500 million, just hit 526, they haven't even been public that long. Okay? All the people that haven't even been around that long, never mind being public, but all the people that work there eat food, live in housing, drive cars, wear clothing, probably all have cell phones. You see what I'm saying? It benefits the entire economy. And one of the mistakes I see a lot of investors making is trying to figure out exactly which stocks are going to benefit the most. First of all, that is incredibly difficult to do. It's like picking Super Bowl winners 3 years out into the future. It's at least as hard as doing that. Secondly, you don't need to do that. It's not necessary. You can use what I'm going to call math over mind. You know the old saying, mind over matter? Well, I've got another saying. When it comes to investing, choose math over your mind. Whatever you think is supposed to happen probably won't happen exactly like you thought it would. So you need to get a methodology in place. It's just a system that uses math that hopefully you've actually tested and makes some sense. And if you have one together, feel free to call 216-901-0945. I'm not going to bash you, I promise. I feel really bad, too, that I think in the past, maybe I was too hard on people that called in. So I apologize for that if I've offended anybody. I don't really mean it. My intentions are all good. When I hear somebody doing something that's really risky or really dangerous, sometimes I get a little upset because I know that eventually that's going to go really south and going to hurt them. So it's not that I don't like them as people. It's that I'm concerned about it. I don't want them doing things that are going to cost them a lot of money one day. And it's one of the reasons I guess I have a job is to try to educate and inform. And a lot of things aren't really worth the risk that you're taking. And that takes a long time to figure out, by the way. That takes a long time to figure out. The vast majority of people pick their investments by how well they've done over the past 1, 3, or 5 years, or the long-term track record. That's a good portion of what you should look at, but it's not the whole picture. And without the rest of the picture, you're throwing darts in the dark. I mean, think about that. How many of you could win a dartboard tournament if you were playing in pitch black? And that's essentially what you're doing when you're looking at just the past performance. You got to know how that performance was achieved. Because if you don't, you're setting yourself up for a potential negative surprise. So what do I mean by that? A lot of funds that might be selecting stocks just based on size alone, market cap weighting, will do very well for extremely long time periods. And then at some point in time, people will have overpaid for a lot of those stocks, and then those stocks will either go down or go sideways for a decade or longer. They do very well when they're going up. When they go down and then try to make back the ground that they lost, it can take an incredibly long time for that. Incredibly long time. So isn't that what you'd love to do? Get up to your retirement age and then watch your investments go down and take 10 years to recover? No, you don't. I was not suggesting that that's a good idea. That's not a good idea. You've got to be very careful about that. And knowing what you can know and what you can't know is actually a big part of being a successful investor. I think that would probably be one of the mistakes I've observed more often than most, is an instance where somebody thought something was going to happen, so they took this action, and they really didn't know much about the whole thing to begin with. They find out when it turns negative, and I really don't like seeing that. I mean, I really don't like seeing that. So I'll speak kind of strongly against that sometimes, and I promise I'll try to clean it up in the future. But I'll just try to politely tell you, that's something that you can't really know. Like somebody asks, well, what's Apple going to sell for? Your guess is as good as mine. Apple's a great company. Awesome. Revenue growth was 15% year over year. That's pretty good, especially when you're doing $247 billion in revenue. But when your entire company is selling for $900 billion, that's almost 4 times. Almost 4 times. It's actually 3.857 now that I look at the number. I did the 4 in my head, by the way. So is it worth that? Probably. Where it is right now, my issue with Apple is it's probably fully valued right here, and it's been that way. It's gone up a lot over the past few years, and I've watched Apple go sideways one time for 17 years. Apple went sideways for 17 years. If you had invested in Apple in 1987, 17 years later, you would have had the same share price you did when you bought it. And that's Apple. That's one of the best companies that's ever existed. 17 years. Now, tell me that you're a long-term investor with that type of time horizon. I think there's only been one guy on the planet. His name was Methuselah. They could have made money with the stocks like that. Okay, so the risk is always there. It's a great company. Don't get me wrong. Apple's a great company. It's just that they make products that change a lot. Actually, I have 3 Apple products in the station with me. So yeah, I like the company a lot. I love their products. Am I crazy about this stock? Not really, but it is in some of the funds that I own. Why? Because when you do the math, it belongs in there until at some point in time, it will not qualify anymore. At some point in time, it's going to get moved out. I promise. I know it will. I just don't know when. It's like you can say, well, I know the Browns are going to win at least another football game before they... I know they will. I just don't know when. And hopefully they'll win a lot this year. Who knows? Yeah, you never know. That's the thing about sports, too. It's kind of hard. Unless you're Golden State, those dogs. Anyway, I hear the music. That means the show is over. Please feel free to reach out to me, Bill at bullingtoncapital.com. Go to my website, bullingtoncapital.com, or call us 330-664-0700. Have a good week, everybody. Good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.